We now move from tail risk to stress testing, which takes a slightly different perspective on downside risk. While tail risk focuses on what has happened historically, stress testing asks a forward-looking question. What would happen to the portfolio under specific adverse market scenarios? We'll start with hypothetical stress test, where we impose predefined market shocks and directly compute the resulting profit and loss. The goal here is not realism in every detail, but clarity and interpretability. Let's look at the stress testing table on screen. The first column shows the assumed shock return expressed as a simple percentage move in the underlying market. A shock of minus 3% represents a moderate but adverse one-day market move. The second column shows the resulting stress P&L obtained by scaling the shock by portfolio value. Under minus 3% shock, the portfolio loss is approximately 30,000. Minus 5% shock leads to a loss of 50,000, and a severe minus 10% shock produces a loss of 100,000. These stresses are intentionally simple and linear, which makes the relationship between market moves and portfolio losses completely transparent. It's important to emphasize that these stress scenarios are deliberately basic. We are not modeling volatility feedback effects, liquidity spirals, or nonlinear instruments. The simplicity is a feature, not a limitation. Simple stresses make it immediately clear how sensitive the portfolio is to large directional moves without introducing additional modeling assumptions. However, in practice, stress testing can become much more sophisticated. For example, commodity or future portfolios may require stress scenarios that account for backwardation and contango, where different parts of the curve move by different amounts. A very simple example. Let's say you trade the future month February and today is January. The February will be impacted higher than, let's say, the December contract because it's nearer. At least if you assume a backwardated market. So you have different effects on different parts of the curve. That might be the case, for instance, if you consider a future portfolio. It even gets more complicated for an option portfolio. However, portfolios with options or leverage require nonlinear stress models that capture the convexity and path dependence. The framework we use here provides the baseline structure onto which these more complex effects can then be layered. In addition to hypothetical scenarios, we can also examine historical stress events, focusing on the worst observed trading days in the dataset. So let's scroll a bit down. This is happening here. So this second table lists, let me scroll a bit lower here. This lists the 10 worst daily returns in the sample, along with their associated profit and loss. Each row shows the date, the realized return, and the resulting P&L for the portfolio. The worst day in the dataset, this might not surprise you if you followed the markets during this time, occurred on March 16, 2020, with a return of approximately minus 10.9%, leading to a loss of about 109,000. Several of the worst days cluster around known periods of market stress, such as said, the COVID-19 sell-off and earlier crisis episodes. These observations highlight that large losses are not hypothetical, they are empirically observed outcomes. Comparing hypothetical and historical stress tests is therefore particularly informative. Hypothetical stresses allow us to explore scenarios that may not have occurred yet. Historical stresses anchor those scenarios in real market behavior. Together, they provide complementary perspectives on extreme downside exposure. In practice, stress testing is used to supplement VAR and tail risk measures. It provides scenario-based insights that are intuitive, very important, communicable, and directly relevant for decision making. While real-world stress testing can be highly complex, starting from a simple, transparent framework is very often the most robust approach. Having examined stress scenarios, we'll now turn to drawdowns, which capture the cumulative impact of losses over time rather than isolated one-day shocks.